Imagine investing 10 crore rupees in a small startup. A few years later, that investment becomes 1,000 crore. You didn't build the company, you didn't run the business. You were just an early investor. This is how investors make massive money from startup IPOs. But the story is not always the same for everyone. Sometimes investors win big. Sometimes public investors lose a lot. To understand this, let's look at two Indian companies, Lenskart and Paytm. First, let's understand what an IPO actually is. IPO stands for Initial Public Offering. This is when a private company allows the public to buy its shares on the stock market. Before the IPO, only founders and early investors own the company. After the IPO, anyone can buy the shares. But here is the key point. Most of the big money is already made before the IPO. Early investors buy shares when the company is small and risky. Because of that risk, they buy the shares at a very low valuation. As the company grows, the valuation increases. By the time the company reaches the IPO stage, the company may be worth 10 times, 20 times, or even 100 times more. This is where investors make their profits. Now let's look at the first example, Lenskart. Lenskart started in 2010 as an online eyewear store. The founder wanted to make buying glasses easier and cheaper. In the early years, the company raised money from venture capital investors. These investors bought shares when the company was still small. As Lenskart expanded stores across India and built its brand, the company kept growing. More investors joined. The valuation of the company kept increasing. Within a few years, Lenskart became a billion-dollar company. Today, the company is worth several $billion and is preparing for a future IPO. Imagine an investor who invested when the company was worth $500 million. If the company goes public at $10 billion, that investor's shares could become 20 times more valuable. That is the kind of return venture capital investors are chasing. Now let's look at the second example, Paytm. Paytm became one of India's most famous digital payment companies. Millions of people started using the app for payments, mobile recharge, and online shopping. The company raised billions from global investors. The valuation kept increasing. Finally, in 2021, Paytm launched one of the biggest IPOs in India. The IPO raised more than 18,000 crore rupees. The share price at the IPO was around 2,150 rupees. But there was one big problem. The company was still losing money. When the stock started trading, the price quickly fell. Within a short time, the stock dropped sharply. Many retail investors who bought during the IPO lost a large part of their investment. Meanwhile, early investors slowly started selling their shares after the lock-in period. This shows the difference between early investors and public investors. Early investors enter when the risk is high, but the price is low. Public investors often enter when the company is already very expensive. That is why IPOs can be very profitable for venture capital firms, but they can also be risky for regular investors. In the startup world, IPOs are not just about raising money. They're also about giving early investors a chance to exit and convert their shares into real cash. Sometimes it works very well. Sometimes it becomes a disaster. And that is the reality of the IPO game.